In the last 7 months, we've seen crazy market movements. S&P down 25%, Nasdaq down 35%, and cryptocurrencies such as Bitcoin and Ethereum down 75 to 80 to even 90%. So in this video, we are going to discuss what is really the state of the market right now, if we have bottom, and really what are the main investments that I'm planning to go ahead in this current state of the market. If you'd like to see updates regarding the market, or you just simply want to know more about what I'm doing with my investments, do feel free to subscribe if you already haven't done so, or give this video a thumbs up or a like if you do find this video useful. Alright, now let's talk about the market updates. So in the past 4 months, we've seen increasing interest rates by the Fed, particularly going from 0.25% to 1.75% in just a matter of 4 months. Now, this has caused a lot of stocks to fall. Now, for example, you have Apple falling by 28%, Meta or Facebook falling by 60%, Google 33%, and then even cryptos, even coins like Bitcoin dropping around 75%. I guess the questions we all have on our mind is that, have we really reached the bottom of the market, and really what to do about it right now? Now, to really answer this question, we need to really go back into time and see how past crashes have really related to our current crash today. Now, looking back to the years like the internet stocks years, or like even the 2019, 2018 crash, or most recently the COVID crash as well, all of these crashes have been caused by non-real estate related issues, right? So unlike the years like 2008, where it was led by the real estate crash, where it was a lot more severe, the average of all of the non-real estate crashes were around 30%, which is very similar to what we're having right now of around 25%. So for real estate market crashes, we can reverse to years like 1929 with a 82% crash, 1973 where there was a 50% market crash, and most recently, I guess you all can remember this, 2008 with 60%. In all of these crashes, you could see that the effects were detrimental. And you could see people losing jobs, and they were depressed, and you could see the effects in real life on the streets as well.
I wake up on a September weekend in 2008 of the largest bankruptcy in U.S. history.
Depression has the federal government stepped in to help a failing financial institution in this country the way they did over this past weekend.
So as you can see, real estate market crashes are very different in their severity. However, for this current 2022 recession, it wasn't driven by real estate. It was driven more by growth stocks, crypto bubble, and inflation, which were all created by the money printing, long-running low interest rates, and expanding debts. Now, since this recession is not really a real estate-led recession, so relatively speaking, real estate has been really not doing that badly. So real estate in the last couple of months has only been dropping around 19%, which is quite good compared to, other stocks and other assets you might have been holding, like cryptos and everything. So as long as real estate is not crashing, in the past at least, the market can still recover relatively quickly. Now, if you want to know more about what I'm really talking about, I'll leave a link down below to the 18.6 year real estate cycle by Phil Anderson. It's a great book and a great take on how the market has been changing in the last hundreds of years. So Phil has really looked into hundreds and hundreds of years of the economic crashes, and really give us a thorough explanations of how things move in cycles of 18.6 years. And this has really helped me in the past, I guess, 5 to 6 years of investing, and it has been delivering quite nice results. So I really do recommend. Now, besides from that, I do believe that we are now in a very attractive level to buy different assets like stocks and crypto. Since looking at cryptocurrency, you see we are at an extreme fear, greed, extreme fear level. While for stocks, we are currently seeing a lot of discounted stocks for sales pretty much. A very attractive level to buy. Now, this has been further confirmed, after looking at the fundamentals of these stocks, and also looking at different professionals, great investors in the world. We see Munger, Warren Buffett and others have been jumping in to buy different stocks in the last couple of months because they do believe that we are at an attractive level to buy stocks. So regardless if you are early, if you have professionals like Warren Buffett buying, it's really a good sign, and it's showing that those investors are also seeing this as an attractive buying level. And following the world's best investors is never really a bad decision. And as long as there is value and good fundamentals in those stocks, you shouldn't worry about timing the market. Now, the stock that I do plan to invest in is Meta, the world's biggest social media platform. And as we all know, in the past 10 months, Meta stock has not been doing very, very well. Now, in 10 months year to date, Meta stock has dropped a significant 60%. However, when you do revert back to Meta's fundamentals and the core business, they tell a very different story. Now, looking at Meta, it has really great fundamentals, right? Now, one of the first things that I look at when I look at different fundamentals and whether a stock is cheap enough to buy is its PE ratio. PE ratio stands for price over earnings. It is a ratio that really dictates how expensive a stock is. Currently, Meta is at 13.85, its lowest PE ratio in the last 8 years. This means for every $1 Facebook is earning, you are paying $13.85 for it. Now, a lot of time PE ratios can differ from one company to others. Being a growth stock, it usually had much higher PE ratios, as you can see here. So being at 13.85 is a very attractive level to buy. Now, of course, looking at the price of a company is not the only thing. You have to look at its performance in terms of earnings and also how much assets it has and the quality of the business itself. Before we get into those, I'd like to firstly look at the ROIC, or return on invested capital, since it gives insight on how much money you can get back from what you put in, which is a reliable indicator of how consistent a stock is performing as an investment. Now, in the last year, the returns on invested capital for Meta has been 26.54%, and this has been very consistent over the last 6 years, with every single year being above 20%. Next, we have the DE ratio, which is the amount of debt a company has over the total amount of equity it owns. Now, this has been 0.12. Now, this again is very low relative to other companies in the same industry. Now, this means there's less risk of paying back bank debts. And this means Meta still has a lot of capacity to borrow for growth in the future years to come. But aside from DE, I also look at a company's earnings consistency whenever I value if a company has good fundamentals, if it's undervalued or not. In terms of Facebook or Meta, in the last couple of years, it's been having 30% EPS growth in the last 5 years, with almost every single year having positive growth. Now, in complement to the earnings, we do need to take into account the growth as well as the net margin, which really talk about how well a company converts their revenue into their profit. So Facebook's gross and net margins have been very high. So gross margin has been 78%, net has been 26%, and it's been very consistent in the last 8 years. And these figures are very high comparatively to its competitors like Twitter as well as Google. And when you look at its current ratio, so current assets over current liability, just to see how the company is going in terms of its balance sheet. So its current ratio is 2.81, and its net working capital, in this case, current asset minus total liabilities, we get $25 billion, or roughly around that. Now, this means they have a lot of resources left in the tank, even when you take away all of their current liabilities. So this is their excess amount of cash, inventories, and other current assets, pretty much. So this means the company still has capacity to invest more. And even in the case of liquidation and the company needs to pay back its debts, it still has $25 billion in current assets, including inventories as well as cash, representing some margin of safety. Now, lastly, but also one of the most important things, is Meta's moat or competitive advantage. Now, with Facebook and Instagram representing 38% of all market share, followed just by Google or YouTube at 27%. This, according to Investopedia, highlights Meta's competitive advantage that can help protect its long-term profits and market share. Now, how about its risk? Now, one of the main risks has been that recently, there's been reports that says that the daily users for Meta have been dropping for the first time ever, due to competitiveness with TikTok and YouTube, and just the younger generation is just not using Facebook as much as before anymore. However, social media is not Meta's only income source. We've seen this company running through different industries, most recently the metaverse, with its recent acquisition of Oculus in the fastest growing technology industry of our time. Looking back at our discussion, while the growth of Facebook has been slowing down, the consistency in its earning, its ROI, and its residual asset for further investment, and its particularly cheap price make Meta a good investment overall, even if the future turns out to be a modest future for Meta. Finally, just to conclude, with the metaverse in discussion and Meta's focus on innovation, I'm very optimistic about the company's future, as well as its status as a value investment. And I do plan in the upcoming few months to dollar cost average to spread out the risk, knowing that I'm very comfortable holding a good investment like Meta in the long run.